When we reflect on the drivers of performance in the third quarter, we isolate it to two key events, two macro-driven events, we would put it. First, coming out of the United States with the US Federal Reserve cutting its federal funds rate by 0.5%. And then later on in the quarter, towards the end of September, we saw a significant stimulus announcement coming out of China that had the intention of propping up its stock market, its property market, as well as its economy. Both of these events helped drive equity markets higher, as well as bond yields lower, which has been positive for bond market performance. Equity markets performed well in the third quarter. The top performing index that we pay attention to was the S&P/TSX Composite Index, the Canadian benchmark for stocks that generated 9.7% on the quarter, its strongest return since June of 2020. That was followed by strong performance out of the S&P 500 in the United States, as well as international markets. Equities in general performed well on the back of improved earnings growth on a year-over-year basis, as well as falling interest rates that helped push valuations higher. Fixed income markets also performed well during the quarter as yields fell. We saw central banks in Europe, in Canada, as well as in the United States each cut its policy rate. In particular, the US Federal Reserve initiated its easing policy with a 50 basis point rate cut in September. Each of these rate cuts helped push yields lower, which pushed bond valuations higher. As we look ahead through the remainder of 2024 and into 2025, despite some of the geopolitical risk with the US election, as well as conflict in the Middle East, we see the environment as generally improving. We do see a soft landing scenario emerging both in the United States as well as in other areas around the world, and this should support equity markets to see modest returns from where we are today towards the end of the year, and should also help bond returns as interest rates continue to fall.